of those.
Go ahead.
Good to go.
Yeah.
Good afternoon, I'm Ben.
I'm Travis.
I'm David. And the stock we will be pitching today is General Mills, which is not part of the Spellman. So for a little presentation outline today, first we'll be going with a brief overview of both the stock and the company itself, involving a revenue breakdown and the different revenue streams. Then we'll be moving into some risks that we see for the stock, followed by some financial and some ratio numbers that we picked out. Then we'll move into the key growth drivers. We have picked out both the pet food industry and North American retail as two key growth drivers that we see General Mills can grow in. Then we will move towards evaluation, how we see the company will do over the next few years, followed by a portfolio fit with our recommendation, and we will give a summary at the end. So to move into the business overview, General Mills was founded in 1928 when actually 4 different flour mills in the Minneapolis area combined into what is known as General Mills today. There are 4 different segments: is North American retail, pet industry, international sales, and North American food service. General Mills business model is General Mills produces and markets a variety of consumer goods and pet products. And they have many staple brands that customers know and love, such as Yoplait, Nature Valley, and staple products like Lucky Charms. About the stock, we view General Mills as a value stock. That is why we are recommending a buy for General Mills. General Mills has had a history of steady dividends or consistent dividends and steady growth, which I'll touch on a little bit further here. And General Mills has a low correlation to stocks in the Spellman fund, which will also be mentioned later. And it is a defensive stock, and there are talks of a recession on the horizons, which I'll touch on here in the next slide. The potential recession is coming. 3 key factors that we have talked about as a group is persistent inflation, labor market struggles, and bank bailouts that have been happening. The persistent inflation, the Fed has set an inflation rate target of 2% in 2024, or won't be reached until 2024. So we could still see some hikes in inflation over the next year or two. Labor market struggles, unemployment is expected to peak around 5% in 2024. Checked this morning, it's around 3.4 right now, so we could see that go up. And the job openings rate is expected to decline. Bank bailouts, recently SVB, Silicon Valley Bank, and Signature Bank have both failed. Many customers have ran from there, which causes a loss of investor confidence. So about General Mills then a little more, we are recommending a buy. This will bring the Spellman Fund to weight of the S&P 500, which we are currently underweight in the consumer defensive sector. We are recommending to buy 92 shares, which is about $8,200. And to do this, we are recommending to sell off a portion of the communication services sector. The current price as of last night was $89.40, and our target price is $94.41, which gives us a target return of about 8%, which does include a dividend. The business, they're involved in the sales, packaging, and marketing in the food processing industry. Some challenges of General Mills that we have picked out: rebounding from COVID, and what comes along with that is the supply chain disruptions they're still recovering from, and some opportunities including the pet industry and organic food and beverage, which brings me into the key drivers that we have picked out of the pet industry and North American retail. And then some risks that we see: supply chain disruptions, inflation, and the potential recession that I mentioned. So now I mentioned earlier about the consistent growth that General Mills has had. This graph here on the bottom kind of highlights that for you. From 2018 through 2022, you can see they're steadily increasing. And then I want to point out the PE ratios and EPS numbers that we've picked out. This graph does kind of go backwards, but from 2020 to 2022, you can see the PE ratio is decreasing and the EPS is increasing, which is what we like to see as a value stock that we have picked out.
General Mills has 4 main revenue streams: North American retail, international, North American food service, and pet. North American retail makes around 61% of their business, which is by far the most. And I'd also like to point your attention to pet, which has a high growth rate. This is a 2-year growth rate because it is a very new introduction into the company. And it's also so high due to a bunch of recent acquisitions that they have been making. But we do expect the growth rate to remain high, which we'll talk about more in So here's a breakdown of the revenue streams from 2021 to 2022. North American retail dropped about 1%, and pet and North American food services both increased by about 2%. As said before, we do expect pet to keep on increasing as time goes on. So looking at our ESG, a few of our pros are they really focus on energy management and ecological impact. They said in a recent report that they are working on reducing emissions across their entire supply chain and expect to reach net zero emissions by 2050. They also focus on employee diversity. Their board, for example, is 50% men and 50% women. And they volunteer with the local community, for example, donating to nonprofits, organizations to reduce water issues. A few other cons for ESG are their business ethics. They have been known to recall a lot of products. Most recently, they recalled a bunch of flour due to E. coli poison or traces of E. coli in it. And they have had previous problems with E. coli in their products. They also have had data security issues, most notably people hacking into their websites. Because General Mills is such a big company and looking at companies of similar size to them, we don't believe that they've done anything super outstanding with their ESG, which is why we rated them a neutral based on ESG. Looking at their risks, their biggest risk is COVID-19 and supply chain issues. They've said that they're still trying to rebuild their inventories from the supply chain issues that they faced and are not quite back at the pre-COVID levels that they had before. So if a disruption were to happen, such as this again, before they were able to rebuild their inventories, it could be devastating for the company. Another very impactful risk that they have is price changes in raw materials. With inflation, there's always a chance that their raw materials will increase, which will just make it more expensive for them to do business overall. So looking at their financials, we decided to compare them to Kraft Heinz and Kellogg's because they're businesses that are similar sizes to them. They're direct competitors. So looking at their PE, they have a lower than the industry average PE and both of their competitors. They also have a ROE, ROA, and net profit margin that is lower than the industry average and their competitors. But one thing to note is their debt to equity is very high, which is concerning, but it has been going down over the past few years. So because we were a little bit concerned about their debt, we decided to take a deeper look into it. So they have $5 billion in long-term debt coming due within the next 5 years. The graph to the right shows the amount of debt that they have reaching maturity each year. But we are not too worried about this because they do have a $2.7 billion in free cash flow this year. They've had right around that number for the last 5 years.
So now I'm going to talk about the first growth driver that we see for General Mills, which is their pet food industry. As of 2022, this segment made up about 12% of their total sales. And that rose from 2021, where their sales were almost at 10%. As the last earnings call, General Mills expects to ramp up their advertising on the wet and dry dog food. And they are doing this now because they were waiting for the supply of those two to get up to about 90%, and that has. So they're going to start ramping up the advertising and marketing on those. Also, their CEO stated that consumers are demanding premium, natural, and humanization of pet food. That's really driving this growth since the companies that General Mills runs for their pet food focuses on the premium pet food brands. And then also over the past couple of years, they've acquired a few businesses that have provided such large jumps in their sales. And these include Blue Buffalo, which they acquired back in 2018, and then Top Chew Pet Treats and Tyson Pet Food, which they acquired in 2021. So some key assumptions we made for these drivers are over the past 3 years, they've had an average growth of 17% in this industry, and that's fueled by these acquisitions. So we expect in the future for this growth rate to decline to about 13% annually. And then we also found the profit margin in the pet food industry to be about 13%. So then the calculations we did were we took their 2022 sales of $2.3 billion and grew that at 13% annually until 2027. And then we took those projected sales multiplied by the 13% profit margin to find their future profits, which we plugged into the EPS calculations to find their valuation. And then the next growth driver we took a look at was the North American retail, which makes up 61% of their total sales. This segment provides the defensiveness that this stock will provide to the fund. as the sales remained pretty steady throughout the years. And so through the ups and downs of a market, these sales have remained pretty steady. And also another potential growth opportunity in the North American retail is the increased investment in brand building. So General Mills collaborates with a lot of celebrities for their different products, and that helps to grow this industry as well. And then also they update their current product branding by offering different specialty items such as miniature cereal brands and also different packaging looks to entice the customers to buy more of their products. And also this landscape here is very competitive, but General Mills is a large enough company where they should be able to outlast and compete with the top players in this segment for years to come. So some key assumptions we made then for North American retail is Americans will still value premium brands during a recession, and that's mainly what General Mills focuses on. Also, in 2022, General Mills decided to streamline their global productions, which really helped to increase their sales over this time period. And then also they expect to grow at 5%. We expect them to grow about 5% annually in this segment. And we got this from taking their last 3 years, they've been growing at about 5% on average. So we just use that 5% annually because this is the defensiveness part. So we don't think it's going to grow too much more than that. And then also we found the profit margin for the North American retail for them to be about 15%. And then the calculations we used where we took their 2022 sales of 13.3 billion, and we grew that at the 5% annually until 2027. And then we multiplied those numbers by the 15% profit margin to find the future profits, which we plugged into the EPS again to find the valuation.
All right, now to get into the evaluation, first we have the pet industry EPS, which we already talked about. We grew that at around 13% for the sales, and the profit margin was right around 13%. So over the next 4 years, we see it right around $0.50, and it's going to go up upwards to a little bit over 3/4 of a dollar. And then getting into the retail side of it, we got the EPS for that. We got that, which was described as like 5% from the last couple of years of what the company average would be. And then we also compared that to the industry average, which was between 4% and 6%. So that was right in the middle. So we decided to stick with it. And then we got the profit margin about 15%. And they grow from a little bit under $3.50 to almost $4. And then we found the other EPS from subtracting the 2022 EPS of pet and retail from the total EPS. And we grew that at a flat rate of 3%. Now comparing the baseline EPS to optimistic and pessimistic. For the optimistic, it is a little bit less than $1 larger. And that's in case, they are able to fix their supply chain issues pretty quickly. And get like an increase in sales and maybe lower cost of goods. So the profit margins increase. And then for the pessimistic side, it's right around a little bit less than $6. And that's in case supply chain issues don't come back very well and it turns bad for them and their profit margins could diminish because the cost of goods could rise. Now we're going to look a little quick here. If you look at the bottom right, we have our target prices. So as we said, baseline is right around $94, with our optimistic being 112 and pessimistic being right above the current price. So that's a pretty large range, and target price range for optimistic is about 22% return to the pessimistic, which is about 2%, which does include the dividend in there. And if we look at the 1 year ahead price, we have $86, $81, and then $103 for the optimistic, pessimistic, and baseline. And then we look at the bottom here, we got the cash flows estimates, which average right around the 170 mark, and it goes up almost to 190.
Yeah, we determined their portfolio fits, and we just described it here in the correlation matrix. If you look, a lot are lower negative correlation with most of the Spellman funds. This is really good. This is going to reduce the risk for the portfolio, and this is also going to increase the consumer defensive percentage. We're underweight right now on the consumer defensive, so this would be a great addition. And then we also recommend to reduce the overweight communication services, which will be in my summary. And then, yeah, the correlation, this is the GIS to the fund correlation, and 10 out of the 31 holdings in the fund have a negative correlation with GIS or General Mills. And 0.041 is our total correlation, 4.1%. And this is going to reduce the portfolio volatility. If there is a lot of volatility going high or low, General Mills is going to sit there really nice. And it's going to improve the overall diversification of the portfolio. So And as a summary, we are recommending a purchase of 92 shares of General Mills. This would be approximately $8,000 to put us on track with the S&P 500. The correlation of GIS would lower the total risk of the Spellman fund. And we think this would be a really good value stock in addition to the fund, which has a significant amount of value stocks, of growth stocks right now in it. And the target price we came up with was $94.41, with a total target return of 8.24%.
Any questions?
You look at me. You know who to start. I'd be happiest. You mentioned 5 billion coming due in the next 5 years. What does that represent of the overall capitalization? Is 5 billion a lot for them?
No, previous years they've actually had more debt than they currently have, and that's why the debt to equity has been going down. So, and they've had a consistent, very strong free cash flow in previous years as well, and are expected to keep that going. So it's not a lot compared to what they've had before, and they've been able to keep the same dividend and that in previous years.
And relative to the overall capitalization, so their debt and their equity, how much does 5 billion represent? Is it a significant portion, or is it?
No, it's not a huge portion of it. It's definitely been more of previous years.
So this is the next 5 years.
Yeah.
Does it look like that every year for the next 10 years, 20 years, 30 years?
No, the majority of their debt that they have now is coming due in the next 5 years, but after that, they have quite a bit freaking up. I don't know the exact numbers on that right now, but.
I have a question. I thought I heard someone say that a recession's coming. Which I find interesting. So why would you say that? And then two, what does that mean exactly then for the stock? What if it doesn't happen?
So I guess the right term is that we can't guarantee that a recession's coming, but it is talked about quite a bit recently. And we're saying we believe that because of the high inflation levels and interest rate levels, and the labor market is kind of struggling to bounce back recently. It is good right now. We're projecting it to get a little slightly worse.
Needs to get slightly worse. That's a long ways from being bad.
Yeah, oh yeah.
What jobs data today?
I got a job.
Yeah, no, but I mean, like, what was the jobs number today? It sounded like the market was cooling for employment and we were headed to a recession. The answer is no.
No.
Jobs,
Oh yeah.
right? No. All right, so if you turn out to be wrong, what are you missing by picking this stock? I mean, are you picking this stock because you think we're headed towards recession?
No, we're picking the stock because we view it as a value stock, and in case of a recession, the defensiveness is an upside, in our opinion.
How do you define a value stock? Because I heard that too. I was just kind of curious. What does that mean to you philosophically?
A stock that's very consistent and pays a good dividend every year.
So very consistent and pays a good dividends. Microsoft, they pay a dividend every year. They're pretty consistent in earnings. Would you consider them a value stock?
I would consider a value stock of reasonably low PE with a good EPS.
Fair. I mean, everyone's got their own definition. I was just curious because a lot of bold statements out there. I mean, that came out hitting hard, which is fine. Along the same lines, you guys talked about if you go to the EPS, I think it's like the third or fourth slide. Right there. So one of the highlights you guys said was that the PE is going in the right direction and earnings are going in the right direction. So meaning I believe that the PE goes down, so it's quote unquote more of a value stock. Earnings are going higher. If earnings are going higher and the PE is going down, I mean, I played football here, so I'm not the smartest guy in the world. So I'm doing the math. Basically, earnings are going up faster than price, right? So if earnings are going up and price hasn't followed, why aren't investors seem to care about General Mills? You guys think? Because if it were to stay flat, like, let's say there's 5% earnings growth, well, the price would go up 5%, right? Because investors would see that and say, okay, well, let's go along for the ride, but it appears like that's not the case based off of the prices, the PE going down. I could be wrong. So I'm saying,
I have an answer, but I'll just-
I have an answer too, but I want your opinion. What's, okay, I'll try to walk you in there without having a board dry erase board. What's the growth of the EPS over the last 3 years? Roughly.
It was up roughly, it's been close to, I think, about 10% over the last couple years. I'm not 100% sure on those answers, but it has been like a decent, maybe low percentage growth.
Yeah, I was just looking.
44 cents on 430 is what.
Yeah, 10%. Is that annualized?
Yeah.
Yeah, okay, so growth, we'll call it 10%, right? Over the last couple of years coming out of COVID, is 10%, do you think investors see that as attractive? Compared to what they could get in the marketplace elsewhere? Based on what's happening with the PE. Are investors loving General Mills over the last 3 years, or they're kind of avoiding, they're ignoring?
Well, yeah, lowering PE could indicate that they are just trying to stay away from it.
Okay, so if they're staying away from it, it's getting 10% EPS. The next step would be investors must be looking elsewhere because there's better growth opportunities. All right. I tried to walk you into that. Is that what you're coming up with?
No.
Okay, good.
I thought, so do we know what unit sales are versus dollar sales?
Yeah.
So part of that's inflation.
Yeah.
So you get the boost there, which helps. Part of the lower PE would be what else is happening? You have it in your slide earlier, I thought. What else is happening in the macroeconomic environment with other sort of investable assets? What is the Fed doing? So if I could buy this bond, the stock that pays a nice dividend, or I can go buy treasuries that are now north of 5%, theoretically zero risk compared to this risk, it makes this one a little less attractive, which brings the PE. You were on the slide with unemployment. Unemployment was 3.4%. So we're getting further away from that recession scenario versus what the Fed is projecting.
Can I jump in there real quick? So instead of, and the answer to the question, instead of saying, a bunch of people are saying, right, like that sounds like a former president, people are saying, we're headed to a recession, like you're the experts now, right? So I know, I just had to do that, it's fun. I can't teach anymore, this is as close as I get. So what you could say is that, today job growth came out, it was higher than expected, true, right? And so that this means the Fed is likely to raise rates again, even though a couple days ago we thought maybe it was gonna be the last one. It's more evidence that they're gonna raise it again. They tend to over tighten, so we think that given current evidence, inflation is still around and they're gonna over tighten, and that's gonna cause a recession. So rather than just sort of relying on sort of expert opinion, which is not necessarily a bad thing, you're now the expert, you should have some chain of an argument to why you get there.
So we had a 5% growth target. By the way, when you broke down the different business units, that was great. I like, okay, here's what the growth looks like in pet food. Here's what it looks like in North America. Here's what our other segment is. Although other segment was bigger than pet food, so maybe a little more thought around that 3% target. Where's that 5% growth coming from? Is that coming from price? Does it come from unit sales, market share? Where do we think 5%? Because everybody can't grow at 5% unless the population's growing at 5% or population's growing at 3% and we're consuming more goods. So where do you think the 5% is coming from?
5% for North American retail.
Yeah, what's the driver behind that? Is it population growth? Is it price? Is it unit sales, which would indicate market share?
I think it might be a little bit of a combination both between unit sales and price possibly. But can't say I would have like a definitive answer for you.
I think I bought the same amount of Lucky Charms every year for the last zero. So I do like Lucky Charms. I just haven't bought it in a while.
As a follow-up to that, do you know, I think you quoted the annual rate has been about 5%. Do you know, in the past, has that come from unit sales or has that come from price increases?
I know in the past it did come a little bit more from price increases as of recently, so. Yes, yeah, a little bit more from. price
So then do you think going forward, they'll be able to implement the same price increases that they've done in the last 3, 4, 5 years?
Yeah, in their 2022 annual report, they mentioned that they believe they keep the same price increases going. But they're not 100%.
And I'm gonna challenge you on one because you answered the question, which is good. But we talked about stable growth and high earnings EPS numbers. So we're gonna hear from Fang. Their earnings per share was $23 last year. Earnings per share here were $5.38. Does that make Fang better?
No, it's
It's gotta be, so we're talking relative terms.
Yeah.
Right, so it's generally you're talking about PE, so if you say we like the low PE ratio, I don't care what the earnings per share are, that's already factored in, that's one of the elements there, so it's how we always want to think in terms of relative valuations, so not just the baseline EPA is irrelevant. EPS is irrelevant, it's that, how does that compare to the price, and how does that PE ratio compare to others? So, and you have that in your table, just answer, I think when you get put on the spot, well, they have great EPS, they have a great PE relative to other companies.
All right, I love your guys' bold statements, by the way. What are your bold statements? You guys gotta be able to back it up.
Yeah.
I mean, that's key. So one of your bold statements was that you think the stock is gonna do good in a recession, right? Let's back it up. Did you guys do the research to see what it's done in the last recession and how that compared to the market in general and other stable stocks? Meaning, did you go back and look at the, look during COVID, how the stock do, how did it do during the financial recession in 07, 08, 09, how did it do in tech bubble boom? Like, you made a statement, so did you actually go back and look at how it did on a relative basis?
Maybe we should have incorporated that in there.
That would have been a strong point. You would have, like actually showed a slide that said, here's the last 3 or 4 recessions, and here's how the stock did versus the market.
Yeah. Okay.
We almost did it. Oh, there's an answer for you. You know, next time you're sitting around going, we should do this. How can they want to ask us? I don't think like, remember this moment.
Did you guys tell
That's
these guys
better
that
than we never even thought of that.
That's true, I guess.
We thought about it. You had any clue?
Ask about that, I just forgot that. That's not really a question.
bold statements, baby, but you gotta be able to back them up.
We should probably.
Thank you.
Thank you.